Hey everyone, feeling that market roller coaster lately?
Yeah, a little bit.
I know I am. It's been kind of wild, right? Especially for some of those, those big names we all know.
Oh, yeah, for sure.
Like DB took a pretty serious tumble down, like 27%,
Wow.
and even Marvel Technology isn't immune, dropping almost 20%.
Yeah.
And Apple shaved off another 18% too.
Mm-hmm.
And those are just like the headliners.
Yeah.
There's a lot more going on.
Yeah, you're right. Those are definitely some eye-catching numbers, but here's the thing. We're not in a full-blown crash just yet.
Okay.
If you look at the overall market, with the S&P 500 and the Nasdaq Q, they're down, but they're holding relatively steady.
So it's more like certain stocks are taking a beating while the rest of the market is just kind of watching from the sidelines.
Yeah, it seems like it.
But I mean, some of these individual drops are pretty scary. We're talking, 30, 40, even 50% losses for some companies.
Right.
What's going on there?
Well, it seems like a lot of investors are feeling pretty pessimistic right now.
Okay.
In fact, over 57% of investors surveyed think the market's going to keep declining over the next 6 months.
Wow.
And this is what we call a bearish sentiment.
Okay.
Basically, a lot of people are feeling negative about the market's future.
That's a pretty big chunk of investors feeling down on things.
Hmm.
Does that actually tell us anything about what's going to happen?
Yeah,
Or is it just a bunch of, nervous energy?
that's a great question, and it brings us to a pretty fascinating point. Historically, when we see this level of pessimism, it often lines up with what's called a market bottom.
Okay.
This is the point where things have sunk as low as they're going to go before they start bouncing back.
So could all this doom and gloom actually be a good sign? Maybe
Yeah.
it's a chance to buy low before things turn around.
It's definitely tempting to think that way, but it's not quite that simple.
Okay.
The stocks that are really feeling the pain right now aren't just any stocks.
Right.
We're talking about companies that had incredibly high growth expectations. Oh, okay.
Think Tesla, MongoDB, AppLovin.
Mm-hmm.
They were soaring high. But this dip is a reminder that even with exciting prospects, the actual value of a company always matters.
That makes sense. It's like that saying, what goes up must come down.
Yeah.
But this whole situation feels a bit familiar, doesn't it?
Yeah.
Didn't we see something similar back in like 2018?
You're absolutely right to bring that up. There are definitely parallels to what happened in 2018. Back then, trade wars and global uncertainty were making investors nervous.
Right.
And this time around, we've got those same factors in play, plus additional concerns about potential economic slowdowns in various parts of the world. And just like in 2018, those anxieties can lead to some pretty dramatic market swings.
Yeah.
If some of these global tensions, ease up, we could see a rebound, similar to what happened in 2019.
Okay.
But if those issues drag on, well, we could be in for a rougher ride.
So we've got those high growth companies feeling the squeeze echoes of 2018, adding to the unease and all this global uncertainty swirling around.
Right. But what about big tech? I mean, these companies are giants. Could they actually crash?
It's the question everyone's asking, especially since those tech giants make up such a huge portion of the market.
Yeah.
And while it's true their valuations are high, their fundamentals are strong too.
Hmm.
Look at Apple's services business.
Yeah.
Microsoft dominating the cloud, NVIDIA's position in AI. They're all powerhouses in their own right.
So they're not exactly standing on shaky ground then.
Not quite. But there's a catch. Your sources mention a few key financial metrics that are raising eyebrows.
Oh.
For example, the price-to-earnings ratio, or PE ratio, is a way to measure how much investors are willing to pay for each dollar of a company's earnings.
Right.
Right now, the PE ratios for some big tech companies are pretty elevated, meaning investors have high expectations for future earnings growth.
So if those growth expectations aren't met, that's when things could get dicey.
Exactly. If their growth rates were to suddenly plummet, those high valuations wouldn't be justified anymore. And that's when we could see a significant correction. Imagine the music stopping at a crowded party. Everyone scrambles for a seat, and some are left standing.
Okay, I get the analogy. High growth keeps the music playing, but if it stops, there's a mad dash for the exits. But even if big tech did take a tumble, wouldn't investors just see that as like a huge buying opportunity?
There's a good chance of that. These companies have proven themselves over time. Their products and services are woven into our everyday lives. Even in a crash scenario, you'd likely see a lot of investors ready to snap up those shares at a discount, betting on their eventual comeback. One of your sources even points out that this type of market dip can be a chance for savvy investors to rebalance their portfolios.
Rebalancing, now that's a term I hear tossed around a lot.
Yeah.
What does that really mean for someone like me trying to navigate all this market mayhem?
It's all about managing risk and maximizing returns. You see, when certain asset classes like high-growth tech stocks become overvalued, rebalancing involves selling some of those assets and reinvesting in other areas that may be undervalued. Think of it like tending a garden. You prune back the overgrown plants to give others a chance to thrive.
So it's not just about buying low and selling high. It's about making sure your investments are properly balanced and aligned with your overall goals.
That's the idea. And rebalancing becomes even more important during times of market turbulence. It helps you stay grounded and avoid making emotional decisions based on fear or panic. One of your sources even calls it the antidote to market anxiety.
I like that, the antidote to market anxiety. It's so easy to get swept up in the day-to-day swings and lose sight of the bigger picture. But rebalancing helps you step back and make sure you're still on track.
Precisely. And it brings us back to what we were discussing earlier about investor sentiment. Right now, fear is running high, which can be contagious. But if you have a well-defined investment strategy and you're focused on the long term, these turbulent times can present some really compelling opportunities.
So instead of panicking, maybe this is a time to take a deep breath, assess your portfolio, and think about whether some strategic rebalancing might be in order.
That's a great takeaway from this conversation. Rebalancing can help you weather the storm and potentially even come out ahead. But remember, it's not a one-size-fits-all approach. It depends on your individual risk tolerance, time horizon, and financial goals.
Yeah, it sounds like rebalancing could be like a key strategy for navigating this current market climate. So let's recap what we've uncovered in this this deep dive.
Yeah.
We know the market is definitely feeling the pressure, but we're not necessarily facing like a full-blown crash just yet.
Right.
Individual stocks, particularly those high-growth favorites, are experiencing some pretty dramatic drops. And then we have big tech, the wild card, with its strong fundamentals, but potential vulnerability if growth slows down.
You've hit the nail on the head. And amidst all this uncertainty, the key takeaway is to avoid panicking. This is the time to be informed, to have a solid plan in place, and most importantly, to stick to that plan.
Yeah, easier said than done when the headlines are screaming about market drops, right?
Right.
What advice would you give to someone listening right now, maybe feeling a little uneasy about their investments?
I'd ask them this. If a major market correction or even a crash were to happen, what would your investment strategy be?
That's a powerful question. It's one thing to discuss these possibilities in theory, but it's an entirely different ballgame when the market throws a real curveball.
Absolutely. Because when emotions are running high, that's when people tend to make impulsive decisions they might regret later. Having a predetermined strategy helps you stay grounded, allowing you to make rational choices based on your long-term goals, not those short-term market fluctuations.
So for our listener out there, if you haven't already, take some time to truly consider that question. What would your strategy be in a downturn? Having that answer ready could make all the difference when things get turbulent.
Couldn't agree more. Being prepared is key, as the old saying goes. Forewarned is forearmed.
Well said. And on that note, we'll wrap up this deep dive. Thanks for joining us. And remember, stay informed, stay strategic, and stay calm.